Hello, and welcome to the Long-Term Investing Podcast with Baskin Wealth Management. I'm Barry Schwartz, Chief Investment Officer. Baskin Wealth Management is an independently owned investment management firm with over $2 billion in assets under management, providing customized wealth management solutions and services to families and foundations. In this podcast, we ignore all the noise and have conversations that make sense about the things that matter in today's markets. It's what we talk about with each other here in the office, and we want to share those conversations with you. Please stay tuned for our legal disclaimer at the end of the episode. Welcome back to the podcast. We got an exciting show for you today. We're going to talk about corporate earnings for a number of our companies that reported. We're going to talk a little bit about Trump and macro, as usual. Try not to talk too much about tariffs again. Our feature discussion is going to be on Brookfield. Sure. And people love Brookfield. We do too. And we're also going to talk a little bit about retirement planning. So I think you will be very, very happy to stay tuned to this episode. In the meantime, if you like our episode, if you like our podcast, The Long-Term Investing with Baskin Wealth, please like us on YouTube, follow us on Spotify, on Apple. 5-star reviews are always welcome. And that's all I got to say for that. So let's get into the podcast. Ernest, we want to talk today about Trump. And we have obviously every day there's something new, worries in the markets. We talked about tariffs before. We talked about uncertainty. We see some very wealthy billionaires saying it's hard to invest in these markets today, given how uncertain it is, not just putting money to work in the stock market, but also building capital projects, right? You don't know if there's going to be tariffs on steel, on aluminum, on auto parts. It's very tough to think long term when there's this dangling sort of very expensive taxes or tariffs on you, as well as that more uncertainty to come. So as an investor, what should we be telling our clients?
Well, I think it's easy to look at the headlines and some of the things that Trump and, not just Trump, but like global politics and in general and what's happening and say, I don't want to own anything.
Yeah. But
I think you have to distinguish between your personal views on geopolitics and how the world should be. And that's a very, very different thing than whether a stock is going to go up or down.
Yeah.
We own the companies that we own because we like what they're doing on the ground. Like we like Microsoft because we think they can sell more Microsoft Office subscriptions. Now, does Trump breaking if he's improving relations with Russia and kind of cutting out Europe, that might have some implications for geopolitics on one perspective. Mm-hmm. But I don't think it really impacts the sale of Microsoft Office Suite subscriptions too much.
I think that's true.
So that's really where we try to focus on and avoid the situations that would be too impacted by the regulatory changes.
Yeah, I'm hopeful that these issues are temporary and we'll be worrying about other major issues in the future. This is what makes investing so hard, of course. That's why we always love to own predominantly companies that have predictable revenue streams, that sell products and services that you can't live without, or invest with management teams that have been through bad times before and know how to get out of those bad times or adjust or adapt their businesses. And that's really the best explanation we can give about it. I see that the U.S. market is up this year. Canadian market is up this year, not much, but we're already halfway into February, almost the end of February. And, we keep talking about this uncertainty. Stocks are doing what stocks are doing. One of the things that we're most excited about is as we're going through Q4 earnings season, many of our companies reporting very strong results. Today, we're going to talk about 3 companies that reported great results, one that didn't. But, that's not a bad batting average, three out of 4. So that's really what we want to focus on. I tweeted the other day, owning cyclical companies can be tough. Owning companies that are commodity sensitive, that have bad business models, those are tougher to own, in my opinion, than a good business. And so that's why a good business, a great business, should command a higher multiple, a higher valuation. People should be paying more up for that certainty, for the quality of those businesses. And so far, so good with the bulk of our portfolio. So I want to talk a little bit about, let's switch gears, talk a little bit about retirement and what people should be thinking about nowadays. On one hand, you've had very strong run in the markets, especially U.S. markets, over the last 5 years, or I guess even going back to 2009. You've had very tough returns in bonds, of course. If you like bonds, you'll love the episode we did last week. It was called Spreading the Risk. But the bond returns now have come down significantly. Bond yields after fees, taxes, and inflation are pretty much putting it under your mattress. The stock market has done very, very well, but multiples, of course, are at high levels. Everybody can tell you that. And of course, the cost of living has gone up dramatically, where we used to tell clients that they needed X to live, to draw out their portfolios, how long it would last for. Those amounts have probably now doubled 5-6 years over the last 5-6 years, just because of the cost of living. Anything to add there?
No, I would. Is there any rule of thumb that you can have for how much clients or people saving in general should have?
And that's a great question. That's typically what we say to clients is, let's see if we can make your portfolio last in perpetuity. Let's assume that when you retire, you may be able to live for 30 plus years, hopefully longer. And as a result, you got to keep that money growing for you for a very long period of time. And so we always tell clients that drawing out somewhere between 4 and 5% of your principal each and every year is probably the maximum you should be doing if you want to guarantee that your principal stays flat or even grows in the future. No question, the long-term returns of stock markets have been more than 4 or 5%. But anything can happen in the future. And of course, Ernest, once you start taking money out of your portfolio and you have a bad year, and then maybe you take money again next year to live off of, and you have another bad year, it's very hard to make back that principal that you took out, especially if you're taking out a high amount. So this really tells us that, A, you have to probably own more in equities, whether you like it or not, over the long term, given that the returns on fixed income are now come down to pretty minimal levels. The bonds, 3.5%, 4%. I see GICs in Canada, if you're lucky, or 3%. These are not, if we're saying that don't take out more or 4 or 5% of your portfolio and you're only getting 4% on bonds and 3% on GICs and 2% on cash, you need to have an allocation to something that has the ability to grow a lot more than that.
And before inflation.
Of course. So we always say to clients that you're in the hole automatically with your money, right? Inflation in Canada, it's 1.9%. But of course, it went up dramatically over the last number of years. Taxes on any of your money, whether it's tax deferred or tax protected, eventually you're going to pay tax on all of it, except for the TFSA in Canada, as well as if you're going to have your money professionally managed, pay someone a fee, hopefully us, you're in a hole, right? So you need to achieve great rates of return just to break even from those levels.
That's right.
Right? So owning a higher allocation to equities makes a lot of sense. What is the magic number? Of course, how much does a couple, for example, in Toronto need to live off of? What is a reasonable amount? I mean, that's really going to be a discussion that you should have with your portfolio manager. And we're here to offer you financial plans and to discuss what number makes sense for you. Or, we can say roughly that a lot of our clients need anywhere from $15,000 to $25,000 a month from their portfolios. I'm talking about a couple who likes to travel, who has grandchildren, who maybe go to a cottage or give gifts to their grandkids, and maybe, God forbid, have to help out an adult child who's having some financial difficulties. So those are the dollar amounts you need to generate from your portfolio or other sources. And, just the cost of living has gone up so much. Ernest, to go out to eat is so expensive. When was the last time you went out to eat?
I went out a lot more during the HST break.
Yeah.
Because not only do you not have to pay tax, you don't have to pay tax on tips.
Yes.
So, and it was reflected in the CPI numbers too, where I think restaurant prices fell 5% because of the lack of taxes, not because prices were actually falling.
And it doesn't, I don't think the price of going out to eat is going to get cheaper. All we can hope for is that it doesn't go up much more. But keep in mind, running a restaurant, they have to pay rent, they have taxes, they have, ordering food, they have staff. Their costs are not going down either. No. So going out to eat is definitely a luxury. And so if you want some recommendations, of course, you can ask Ernest, because he has, Ernest is a connoisseur of food. So that's, the little spiel about retirement and wealth planning. It's important to think about these things. We like to talk high level here about equities and what we're thinking about in terms of the markets, but it's important to remember that you have to focus on portfolio management and the right asset allocation, which makes sense for you. And feel free to contact us to discuss all these wonderful things. Let's run down some corporate earnings, unless you want to have anything you want to add on to that.
Well, we do have financial planners at our firm.
We do.
Certified CFPs.
We have two CFPs, and all of our portfolio managers can certainly help you out with all your wealth planning, financial planning needs.
Yep. Well said.
So you want to talk, let's start with the bad news.
Okay, sure.
Always get the bad news out of the way. So we had a pretty nasty move on TFI International. It's a stock that held in client portfolios probably now 20 years.
Yep, 2004.
Wow. So time flies. I said at the beginning of this episode, I talked about cyclicals and commodity type businesses. They're not always easy. And it really showed in this quarter with TFI. So Ernest, we're doing this episode on February 20th. TFI reported its earnings February 19th. You read the conference call notes. Take it away.
Yeah, I think stock's down like 18% as of like 10 minutes ago.
We're not going out to eat for a long time after that one. Yeah.
Yeah, but I think there's a couple of things going on with TFI. So TFI is a trucking company. We've talked about I don't want to rehash their entire business model again. But the long story short is that they have a division called T-Force Freight, which is a less than truckload provider in the US. You can search up what that means on ChatGPT. And so they bought this business in 2021. And at the time when they bought it from UPS, it was a money-losing business. But TFI believed that they had the ability to turn this around. And it's a relatively attractive segment of the trucking market. So where there are companies that earn a lot of money providing these services, and that they thought they could do that. What ended up happening is that they did, to some extent, they are making money on this division now, but the turnaround has been a lot slower than expected.
Yeah, it was one step forward and about 7 steps back.
Yeah, and like half of this is just that the trucking market overall is in a really rough place.
Why is that? What's the explanation for just a tough trucking market? Is it still overhang from the supply chain crisis from the pandemic?
Yeah. I think there's two things. The first is that just industrial production overall in the U.S. Is quite sluggish. Like everybody's uncertain because of things like tariffs and the economy.
Yep.
And retailers are are still, no, they're generally cautious about consumer demand. So these are all things that are impacting the trucking demand. And then on the supply side, you still had a lot of trucking companies that added a lot of capacity in 2022 because of the trucking shortages. And so, when there's a lot of supply and weak demand, then pricing goes down. And that's kind of what you're seeing. And because TFI, T-Force Freight, is a higher cost provider, they are, I think they gave a variety of reasons specifically why they're performing poorly. But the reality is that they're a smaller player, and the smaller player is going to get hurt more in bad times. And so that's what's happening.
So it's a tough freight market for all.
Yeah.
It's not like TFI reported bad earnings and all of its peers reported terrific earnings.
Right.
It's just TFI's earnings were a lot worse
Yep.
than a lot of the other. Now, it's not like TFI lost money. It's still an extremely profitable company. The earnings unto themselves on an absolute basis look pretty good.
I mean, sure.
Fine. It's like okay, stock doesn't go down 18%. Shouldn't go down 18% on a very profitable quarter, especially a quarter where you generated an enormous amount of free cash flow. So we just have to hope for better times ahead. But clearly, it's the two sticking points are the macro sucks. Just the freight industry is tough, and that's going to take time to right itself. And specific issues that TFI had given to their business or operations. I think they also had higher accident costs this quarter.
Yep.
Yeah. So
Claims. Yeah.
claims.
Yeah.
So maybe due to bad weather or just poor drivers, these things can happen from time to time. So given how bad the stock has moved, what's the reasons to be positive going forward? Because we always want to talk about the positives.
Well, I think there's good reason to think that eventually, first of all, the trucking market is going to get better at some point. The trucking cycle, it goes through these ups and downs over time. And what happens is that in bad times, capacity leaves the market, and then demand eventually picks up, and then rates go up, right? So that will eventually come back. With regards to the operational performance at T-Force Freight, they did about. So one of the things that the market was really surprised at was that they only earned 3% margin, roughly speaking, in the fourth quarter. Mm-hmm. So every dollar they only earned 3 cents at this division. In 2022, they were doing about 10% margin. Mm-hmm. And that was before they had upgraded a lot of the systems and replaced a lot of the trucks and improved a lot of the processes at this business already. So there is good reason to think that performance will be better going forward. And they also, to your point, they're still generating a lot of free cash flow, which they can use to make acquisitions to help them gain the scale to catch up to the larger players in the industry. So
I noticed, sorry to interrupt, but I noticed Elaine Bedard, the CEO, said today, he said, it's a tough time, probably one of the worst freight recessions we've been in, but we're ready to make acquisitions and be bold here because when things do improve, we're going to have to pay up for these acquisitions. And it does have the balance sheet and the free cash flow. And if it rights some of these operational issues while waiting for the freight industry to improve, this could be the right time to continue to bolster its line.
And it's worth noting that TFI's been through this before.
Yeah.
So in 2016, they made a large acquisition in the U.S. in the truckload market, where they bought a company called CFI.
TFI buying CFI.
TFI bought CFI.
Got it.
The idea was that they could buy CFI at a weak point in the trucking cycle, improve operations, and then make money. Mm-hmm. What ended up happening was, again, the trucking market got worse. And then quarter after quarter, they were reporting like deteriorating performance at CFI, and analysts were wondering when it was going to turn around. Yeah. Until it did, and then they sold it in 22. So there is precedent for TFI to have gone through a similar experience, and I think good reason to think that they will figure it out at some point.
That's right. This is a company that generally has improved operations at all of its acquisition targets. It's a very acquisitive company. I think they've made 700 acquisitions
Yep.
in the last 10 or 20 years. I can't remember the exact number, but many a year. And the issue, 700 sounds like too many, probably 70.
No, not 700.
No.
Well, most of them are
Yeah.
are small deals, like
Yes.
a local trucker
Mon pa
in
trucking.
like Quebec or something.
Got it.
right?
The number and the business in Canada was pretty good. Their logistics business, their parcel business was pretty decent. So it's never going to be a straight line for any company. We aren't happy. You shouldn't be happy to see a stock go down that much in any one day. But these are the types of things that happen with more cyclical businesses. And we trust that the management, we've owned this for a long time. We've seen some nasty things in this business, and we think they'll be positioned quite strongly when the cycle does pick up. So we're doing nothing. We're certainly not selling it at these levels.
Also re-domiciling to the U.S.
Yeah, very interesting. And that's because the bulk of their business is U.S. related.
Yeah, so there was a little bit of buzz about this where some people tried to create a narrative that, it's like another evidence that Canada's losing a company to the U.S.
Not
right?
true.
But I think what this is actually, what's actually going on is that TFI is just doing some paperwork to change their headquarters address, not the people, but just the address from Canada to the U.S. And there's a couple of reasons for this. The first is that because after they completed the stock listing in New York, most of their shareholders today are in the U.S. And so because the way that the reporting regulations work is that once a Canadian company has more than half of its shareholders in the U.S., it now has to follow U.S. accounting rules. And so there was no reason that they were still going to maintain that they were a Canadian company because from a fundamentals perspective, like their revenues, their shareholders, all of these are American. Like most of them are coming from America. And so it is an American company. The other benefit, I think there's two more benefits to the re-domiciliation. Is that, I don't know if that's a word.
We're allowed to make up any words we want. It's our own podcast. Yeah.
Another thing is that when they bought Daseke about a year ago, that business has some contracts with the Department of Defense. And the management felt that being an American company is probably helpful to maintaining these kind of contracts. And then the last benefit, of course, is that if you're an American company, you become eligible for indices such as the S&P 500, and then you might get some valuation lift as well.
Yeah. So we would definitely love a little valuation lift, make us feel better after today. So I think that's a good overview of TFI International. If you have any questions, please reach out to your portfolio manager about that one. On the plus side, we had a number of companies. Most of our companies reported phenomenal earnings. Moody's, Watsco, Garmin, three stocks that we've also owned. Garmin not as long, but Moody's and Watsco for quite a long time. All three reported strong top line organic revenue growth. Most of them raised their guidance for the 2025 year, saying their end customers are spending lots of money on their products. So let's just run through quickly, start with Garmin. And if you like Garmin and you want to learn more, we did a podcast on it. Please sure to check out our wonderful podcast on Garmin and why we bought it.
Yeah, so Garmin had a really good finish to the year. I think people are just buying a lot more of their products, their watches, their indoor bike trainers, their boat sound systems, and excuse me.
Did they launch a golf simulator also? Did that?
Yeah. They launched a
indoor golf simulator
golf simulator that comes with a launch monitor, which I think is a revolutionary. Well, I think it's revolutionary because never before were those two things combined into one system.
Yeah.
You usually have to buy the simulator and the launch monitor, but now it's all available.
Incredible.
And I don't golf really, but from what I read, people think it's a game changer.
Wow.
So, but anyways, They grew 20% in 2024, and they think they're going to grow another, I think, 7% in 2025.
And this is a company that generally gives quite conservative guidance.
Yep.
This was not, if I recall correctly, when it started 2024, it did not give guidance that it was going to grow 20%. It was more, I think it was low double digits. And they totally smashed their guidance that the entire year.
No, and I think, and it was just good execution. Like people like their products. They make good watches. They make a technical thing. They're adding new technical features all the time, and people want to buy them. And that's what's driving business performance.
I still don't have one. So it also raises dividend earnest 20%.
Yep.
Balance sheet debt free. It also was active on the share buyback, which is probably interesting to a lot of people to see a company buying back its stock at a higher valuation and its stock at an all-time high.
No, I think that part is especially interesting because Garmin is what we consider to be a company that is very careful with its share buybacks. Like they historically, if you look at their capital allocation through the years, they only buy back stock when they think it is attractively valued. And last year, they were buying back stock at the beginning of the year when the stock was down in the dumps. But then after the 90% rally, they were still buying back stock, which tells you that they thought things were still very good.
Incredible.
And that's what happened.
All right. Watsco doesn't make anything, but it distributes HVAC, new HVAC units as well as parts to contractors all across North America, primarily in the U.S. This was a company where people probably thought, okay, the U.S. economy, how home building is not doing so great because of interest rates. The U.S. consumer is probably suffering because of higher inflation. Probably Watsco is going to report a pretty mediocre or quiet quarter, but it reported just the opposite. A stunning, I think, 9% organic growth.
14% equipment sales growth.
So, I mean, it was pretty cold this winter. So maybe people needed new furnaces, or everybody's furnaces broke at the same time. But that is that out of character for Watsco?
Yeah, I think it was unexpectedly strong, and I think I probably wouldn't want to extrapolate one quarter as a trend going forward. But they did note that that their technology platform, so they have a bunch of apps that they make for contractors to go and sell systems, to make it easier for them to find inventory, recommend the right air conditioner for a customer. They said that contractors are using more of these apps, and that's driving new business to them. That's something that you always like to see. And then the other thing that they think is going to be a benefit for them in 2025 and going forward is the regulation change for refrigerants. So the U.S. currently is shifting from one refrigerant to another type.
Okay.
Which is called A2L. The new one's called A2L systems. And these have they're better for the environment. And so that's why they're making new air conditioners for these.
So going forward, air conditioners can only be sold with this refrigerant.
Yes.
And so you have to buy new ones that are modified, probably pricier. And
10% pricier.
And probably not, and more expensive to fix. And these have got to be good things for Watsco.
No, and I think the key is that not only are prices higher, which is good for a distributor like Watsco because they're making 10% more.
Yep.
But also when a customer, when your system breaks, now you're more likely to switch because it's harder to fix your old one. And the thing about the A2L systems is that you can't just replace the outdoor unit. You have to do both the outdoor and the indoor, like the air handler and the compressor, because the new refrigerant is slightly flammable. So you can't, it's dangerous if you don't replace the whole thing.
Well.
And so
don't be doing this yourselves at home.
No, so the benefit for Watsco is that there's going to be more sales going forward. That's the big story.
Excellent. In the meantime, Watsco raises dividend 12%. Watsco said in their press release that it's raised it paid a dividend for 51 years, and it's raised its dividend every year for, I think, the last 12. Terrific shareholder returns. I think this is a company that's compounded rates of returns for shareholders in the high double digits for going back 35 years. So you've done quite well on Watsco. Balance sheet is debt free, and the company grows by making acquisitions, acquiring ma and pa distributors, and there's lots of them. Contractors need steady supply. Having that app, of course, probably is very good for contractors, knowing what's in stock, when to order it, how to fix things. I think Watsco has just got a good long-term runway as well. And then Moody's, which is the bond rating company, as well as owning a number of proprietary databases, is a company where people were a little bit worried, Ernest, because of rates not coming down as fast as people expected in the U.S., as well as just a wall of new bond issuers maybe not being as robust as it was the past few years. If you recall, coming out of the pandemic, interest rates plummeted. Everybody issued bonds, and interest rates skyrocketed. Who was going to issue bonds at those levels? And so when interest rates came down, people issued bonds like crazy again. All these bonds need ratings, and now that things have kind of stabilized, there's a worry that things aren't going to grow. But Moody said, we're raising our guidance well ahead of what Wall Street was expecting for 2025. So, any quick thoughts on Moody's there?
No, I think your point is exactly right. Yeah. What happened for Moody's was that everybody thought that 23 and 24 was just people refinancing bonds that they otherwise were going to that they didn't issue in 22.
Yeah,
and that this is a finite source of growth, and that going forward, Moody's growth would fall off because people already issued the bonds that they needed. I think Moody's is saying that 25 will probably be a pretty good year still because credit conditions are still quite favorable. But more importantly, they're favorable for the types of bonds that Moody's makes the most money on, which are high yield and like infrequent bond issuances for mergers and acquisitions.
Okay.
So, and the reason why the environment is favorable is because high yield spreads are very low, and also there's a lot of private equity dry powder available to do mergers and acquisitions. So, 25 is probably going to be a good year again. I think more importantly is that the analytics business and the recurring base of the ratings business continues to grow. So even to the extent that, let's say, inflation picks up and bond issuance goes down again, there's still a large amount of revenue that is still going to be there and growing quite nicely over time.
And in the meantime, Moody's keeps making small tuck-in acquisitions, sometimes some meaningful acquisitions, always looking to expand its credit rating business, its analytics business in different countries and different verticals. So it's still a growth business.
Also using AI to replace analysts.
That's going to be we're going to do a topic. We're going to do a podcast on AI, talk about our experiences using AI. Look for that real soon. Our feature discussion is on Brookfield and Brookfield Asset Management. Brookfield raises dividend 13%, the parent. Brookfield Asset raises dividend 15%. Brookfield Asset is the fundraising arm of Brookfield. It's the one that manages all the money. Brookfield is a parent. We prefer the parent, but both have done quite well since the spin-off of Brookfield Asset from Brookfield. Brookfield Asset, I think Ernest, when it was spun off, said to the market, if things go well, we're going to raise our dividend 15% a year for the next 5 years. So far, they've delivered on that. So what did Mr. Flatt and the team have to say about Brookfield in its most recent quarter?
Well, we get a lot of questions about which Brookfield we like. And it seems to me that a lot of people don't really understand the differences between all the Brookfields out there. Like you have Brookfield Corporation, you have Brookfield Asset Management, then you have Brookfield Infrastructure, you have Brookfield Wealth Solutions, you have Brookfield Renewables.
Yep.
And these are all like stocks that you can buy on through your brokerage.
You can also invest in Brookfield products
Yep.
that they have both publicly traded as well as through your advisors, right?
Right.
So it's should I buy the Brookfield stock? Should I buy the Brookfield spinoff? Should I buy the Brookfield product that they're selling? Who the hell knows?
Yeah.
Yeah.
So Brookfield Corporation is the mothership. It is the one that drives all the decisions at all of the various Brookfield entities. It owns, its largest asset is its 73% stake in Brookfield Asset Management, which is the business that, raises money and earns fees for managing that money. And the reason that we like Brookfield Corporation is because that's the one that all the money eventually flows up to. And that's the one that is owned by all of the partners at Brookfield that you can expect to continue to compound value into the future.
So the incentives are driven by who owns what, and given that most of the Brookfield senior management team has their biggest stakes in Brookfield,
They own
the
about
corporation, you probably are certain that they're most incentivized to get that stock up the highest possible.
Right. And I think over time, as you track the transactions that Brookfield has done and kind of the decisions that they make at all of the subsidiaries, you can very clearly see that they favor Brookfield Corporation. So for example, when they spun out the asset management business, they structured the agreement for the carried interest, which is the performance fees on the funds that Brookfield Asset Management runs. They structured it so that Brookfield Corporation gets all of the carried interest on funds that already existed on Brookfield Asset Management funds.
Yeah.
Which doesn't really make any sense if you're buying the shares of the asset manager.
That was the deal of the spinoff.
Yeah.
Yeah. And they're still going to take a portion, the parent, of the carried interest on future sales as well.
Exactly.
Right? We own the brand name. You're using our... It's essentially Brookfield Corporation is a royalty play in disguise.
Yep.
Yeah.
And they, from time to time, they'll sell shares of their Brookfield affiliates and of asset management when they think the price is high. So they did a secondary offering of Brookfield Renewable in 2021 when everybody loved renewables. And they'll buy stakes in things that they think are undervalued. So they bought full control of Brookfield Property again in 2021 when they thought that it was undervalued.
So I want to touch on, really the contentious part of Brookfield and why a lot of investors were worried about Brookfield a couple of years ago was its real estate exposure, right? That's a meaningful part of Brookfield with rates where they were in 2022, with worries about work from home, inflation, what have you. Brookfield stock did not do well. And one of the reasons was because everybody said, well, it's exposure to real estate. You read in the paper, it was handing back the keys to some banks for some properties that it's owned. Didn't want to pay the mortgages. Have things stabilized there?
Yes, they are reporting good occupancy rates for their real estate portfolio, which they own 100% of.
Thank you, Jamie Dimon, who's forcing everybody back to work. Yeah.
I think the commentary from CoStar Group, which we own, has said that demand for office space is definitely improving. And not only that, but supply of office space has shrunk meaningfully. So they expect rents for office to go up a lot.
Please don't tell our landlord, but we're looking to, our lease comes up, Ernest, here probably in 2026. We've grown over the last 10 years since our lease. We're going to need a little more space. And from what we're hearing from our landlord, they want to charge a lot more for rent, even though, everybody's still working from home or working from home 2 or 3 days a week. This is what's going on. So there is demand for office space, and that's creeping up all across North America.
And interest rates are falling again. So they're able to refinance a lot of the debt at Brookfield Property Group at lower interest rates as well. So that's helping.
Excellent. And rents are going up too, right? So things are working out in its favor. And I think it's sold some of the properties that it wanted to get rid of, and so that's reducing some of the risk that that's a lot of their properties were lousy or they would have to be given back. Now things have at least stabilized and even turned around in some of their real estate divisions.
No, I think the big knock on Brookfield is that a lot of their businesses are quite circular, right? So Brookfield owns Brookfield Property Group, which is managed by Brookfield Asset Management. So Brookfield Corp is paying fees to Brookfield Asset Management, but then that flows back to Brookfield Corp through the dividend. And that's true for a lot of the various Brookfield affiliates, where it's like money coming in from one end to the other. And
well, you're giving me a headache on that one.
Exactly. Yeah.
Okay.
And so it's not really, a lot of people criticize Brookfield for not being very transparent on all the dealings between all the various affiliates. But what I come down to is that at the end of the day, the partners own 20% of Brookfield Corporation.
Yeah.
And this is all their money. And if this thing was a fraud where it was a shell game to prop up the cash flows, why wouldn't they be selling stock hand over fist?
It makes no sense.
Right?
They actually buy more stock. In the meantime, Brookfield, in Bruce Flatt's latest letter, he said $1 million invested in Brookfield, the parent, 30 years ago is worth $180 million today, which is shocking. And that's not just holding Brookfield shares, but holding all the spinoffs, collecting all the dividends, compound returns, way better than the S&P 500. And now these guys are great promoters, they're great salespeople, but they think the future is as strong or stronger for Brookfield going forward as it continues to get scale. Very excited about its insurance division, which is delivering a fair amount of profits. They think it's going to be a big part of their business going forward. Recovery in real estate, offering more funds, participating in infrastructure through AI, and God only knows what else they're going to get into. These are not guys who sit on their hands with one line of business. They're actively looking to collect more fees. It's a fee collecting business, and they want to collect more fees. The final thing that I'll say is in Bruce Flatt's letter, he talked about you guys are not giving us any credit for all these performance fees that we're eventually going to collect when our funds finally stop and return money to their shareholders, right? Or when our funds finally reach a certain maturity age, we're entitled to a huge return of performance fees.
Yep. Which goes to Brookfield Corp.
Which goes to Brookfield.
As we talked about.
Exactly. So they think that that's really going to start to materialize probably in the next 10 years. In the next 5 years, they'll collect a good bunch of it. But in the next 10 years, they believe they're going to collect an enormous amount and launching new funds all the time, which will generate more carried interest if there's strong performance. So we're pretty excited about holding Brookfield long term. Anything else you want to say about that one?
So what I love about Brookfield is that they view every announcement as an opportunity to make money. So, for example, when I think Trudeau thought about launching a Canada fund. Do you remember that?
Yes, like a sovereign wealth fund for Canada?
A sovereign fund for Canada. Mm-hmm. No, I think a lot of commentary was like, well, why are we wasting money on this? Mm-hmm. But Brookfield's attitude would be, they looked at this and be like, yeah, let's do this. We can be the ones to manage it, right?
Exactly.
So they're looking for opportunity. They're always looking for opportunities on how to raise more money and how to earn more fees.
And how to participate. Trudeau announced a high-speed rail looking to connect Toronto to Quebec City, 3 hours, Toronto, Montreal. That's going to be a multi-billion-dollar project. Brookfield would be gladly interested in providing financing and involved in some type of the infrastructure as well. That's their bread and butter. So look for Brookfield, lots of Brookfield announcements going forward. So that's all we have for you this week, and we'll see you back here real soon. This podcast is for informational purposes only, and any forecasts on the economy, markets, or individual securities should not be viewed as investment advice, a recommendation or an offer or solicitation to buy or sell any securities. Clients of Baskin Wealth Management and the speakers on this podcast may own shares of the companies discussed. Information on this podcast is current as of the time of production and is subject to change. If you have any questions or would like to subscribe to these podcasts, visit our website at baskinwealth.com.